Hey guys, welcome to Stock Talk with Nico Criticos. Today we're going to be comparing free cash flow to net income, and we're going to be seeing which one is more important and which one has a more stronger impact on a stock price long term. So I have a couple different examples here. These four stocks that I have pulled up are all stocks that I own, and the first one we're going to look at is going to be Walgreens. So Walgreens in the last 5 to 10 years has been a pretty bad performing stock. As you can see, in 2015, the stock was $83 or so. Today, the stock is trading around $32. So this will be an example of a bad stock price depreciation, right? And if we go to free cash flow, we're going to see that free cash flow is kind of correlated with the stock price. The free cash flow has pretty much gone nowhere. It was a little bit higher through, 2015 to 2021, it was higher, but from 2009 to 2014, it was pretty much flat. And then last year, they did even less than what they did over a decade ago. So the free cash flow has been very weak. If we look at net income, what we're going to see is that net income is not super consistent. It has grown a little bit. You could say that it was flat from 2007 to 2014, and then it kind of became a new standard of about $4 billion from 2015 to 2022. So I would say a little bit more growth in net income than in free cash flow, and we have a bad stock price. Then we're going to go to Verizon, and what we're going to see is Verizon is also another stock that has had a bad, really 5 to 10, the 5 years have been worse than the last 10 years, but the stock price has not gone anywhere. It's been, $50 or so. Today it's about $40. So the stock price has not gone anywhere. And this one's a little bit more interesting because if we go to net income, what you're going to see, if we go to annual, you will see that net income has actually gone up, right? But even though net income has improved from, let's say, 875 million in 2012, and they've gone all the way up to 21 billion. So for the last decade, they pretty much doubled their net income. So you would think the stock price would have gone up, right? Well, no, it didn't. And that's because free cash flow is weak. Free cash flow has gone nowhere. Since 2002, this is 20 years now, the free cash flow has been roughly $10 billion. That is why it kind of looks like free cash flow is more important. Then we're going to go on to 3M. 3M is another stock that has had a bad 10-year period. It's trading at where it was 10 years ago. So it doesn't get much. Now, there was money to be made here because there was some appreciation, but we're back down to where we started. So first we're going to look at net income, and let's look at annual because annual shows a better picture. And we are going to see that net income has grown. So you would think the stock has gone up. Remember, this stock has been flat for a while, and net income has been increasing for over 20 years from 1.4 billion to 5.7 billion. But free cash flow is roughly flat. It's not bad. There's a little bit of growth you can see in there from, let's say this period about $4 billion up to 6.6 in 2020. But we're back down to 3.8 where we were at over a decade ago. So not very good. And then our last example is going to be PayPal. And PayPal is a stock that in the last 10 years, this stock is pretty much flat once again. And if we look at net income for this stock, what we're going to see is that first we got to change it to annual. And what we're going to see for the net income is it's once again, it's grown a little bit, but it's not a ton of growth, especially the last year. It dropped a lot. And if we go to free cash flow, what you're going to see is that a little bit more growth. But so let's say we take 2013, 1.6 billion to 5.1 billion over the last decade. And this stock price is similar. It's kind of flat like the others, but if we're talking from 2013, the stock price is pretty much double where it was, which is better than the other companies. So this stock price is pretty much doubled, and that's with free cash flow roughly going from, let's say, 1.6 to 5.1. So a little bit more than a double up. And then net income in 2013 was a little bit under $1 billion, and we've gone from, you could say they 2x to 4x their net income. So as far as I'm concerned, net income is important, but it looks like free cash flow is just as important, if not more important, because it looks like free cash flow correlates better with the stock price over an extended period of time.